Listen carefully, because what I'm about to say sounds insane until you actually run the numbers. Silver is sitting around $80 an ounce right now. And if I told you that one day, $80 might look the way $5 looks today, most people would laugh. They'd scroll past. They'd say this is just another internet voice chasing attention with ridiculous price targets. But stay with me, because I'm not asking you to believe me. I'm going to show you the math, the history, institutional research, supply data, and the geopolitical mechanics driving this market right now, step by step. And by the end of this, you won't think $300 silver is crazy. You might start thinking it's conservative. Here's what we know right now. Silver just printed a nominal all-time high at $121.64 in late January. Then in just 10 weeks, it collapsed 44% to $67. And now, it's climbing back, holding near $80 while a real-world conflict is unfolding around the most critical oil shipping route on Earth. That's not noise. That's a setup. Most investors look at this and see chaos, volatility, a market they can't trust, so they walk away. But the smart money? They see something completely different. They see a physical asset running its sixth straight year of structural deficit. They see industrial demand, solar, EVs, AI, locking in a trend that doesn't reverse on a headline. They see a Federal Reserve cornered, holding rates higher than it wants because oil-driven inflation won't let go, yet knowing that the moment that pressure breaks, the entire setup flips. And right now, they see silver at $80, still 34% below its recent all-time high, and they don't see a peak, they see the beginning. Now understand this clearly, this is not financial advice. This is education. Silver is volatile. You should always consult a qualified financial professional before making any investment decision. But if you stay with me, we're going to build this from the ground up, piece by piece, because when we get to the $500, $700 scenarios, I don't want you guessing. I want you to understand exactly how we got there. Let me challenge what most of you believe right now. You either think silver is too chaotic to understand, or you think the move to $121 was a bubble that already burst. Both views miss the core truth. That drop from $121 to 67 Zaccos was not a failure of fundamentals. It was the system, margin calls, forced liquidations, algorithmic selling, paper contracts unwinding at scale. Meanwhile, the real world didn't change. Mines didn't suddenly produce more. Solar, EVs, AI, they didn't slow down. Physical demand kept moving. In fact, the market is still facing a projected 67 million ounce deficit in 2026. So what you're seeing isn't silver topping. It's a paper correction sitting on top of an unresolved physical shortage. Now look at today. Silver is trading around $79.80. A small pullback from $82, driven by weekend tensions near the Strait of Hormuz, pushing oil higher. Inflation expectations up, and forcing the Federal Reserve into a tighter stance. But zoom out. Last week, easing tensions sent oil down, the dollar lower, yields falling, and silver jumped 6% in days. That's the signal. Macro is shifting. Supply is tight, and silver, it's caught between two systems, paper pressure and physical reality. Now understand this, silver doesn't move in isolation, it competes. When the Federal Reserve holds rates high, Treasury yields rise, and institutional money leaves silver for income-producing assets. But when rates fall, that flow reverses, the opportunity cost drops, and capital comes back to hard assets. Add the dollar. Silver is priced globally in US dollars. When the dollar strengthens, silver becomes more expensive worldwide. Demand weakens. When the dollar falls, silver gets cheaper globally. Demand rises. Two macro levers, rates and the dollar. Right now, both are slowly tilting in silver's favor. But here's what most miss. There's a growing disconnect between paper silver and physical silver. The COMEX is showing critically low registered inventories. China has tightened export controls. Lease rates have spiked, real stress in the physical market. Paper prices can be pushed around. Physical prices cannot. And history is clear, when that gap widens, the paper market eventually snaps back to reality. Violently. Now look deeper. This is not cyclical. It's structural. The Silver Institute confirms 2026 is the sixth straight deficit year. About 67 million ounces short, with over 700 million ounces already drained from reserves since 2021. Supply can't respond. Demand isn't slowing, it's accelerating. Solar. Now we get to the part that actually drives this market: real demand. Solar alone is pulling in roughly 200 million ounces a year. Installations are still growing around 15% annually. Yes, manufacturers are trying to reduce silver per panel, but total demand keeps rising because volume is exploding faster than efficiency gains. Then you have EVs. Every electric vehicle uses about 1 to 2 ounces of silver. Battery systems, sensors, power electronics, with global production pushing toward 15 million units. That's up to 30 million ounces a year and climbing. And then comes AI. Data centers, power systems, cooling infrastructure. Silver sits inside all of it. And here's the key: silver is a tiny cost in these builds. That means buyers don't care if it's $30 or $80, they buy what they need. That's inelastic demand. Now combine that with a structural supply deficit and history starts to matter. After Nixon's shock, silver ran from $1.50 to nearly 50 cents. From 2008 to 2011, it surged over 400% under zero rates and QE. Same pattern, different scale. Silver doesn't move slowly, it compresses and then it reprices. And now, for the first time in decades, the setup looks familiar again. Now let's build this the right way, layer by layer, with math, not emotion. We're not talking about fantasy targets. We're talking about ranges grounded in institutional research, historical ratios, and macro mechanics. Start simple. Major institutions like Bank of America and Citigroup are already pointing toward $135, $150, even $300 silver. Not fringe voices, these are the largest research desks in the world. Now run the math yourself. At a gold price near $4,800 and a gold-silver ratio around 60 to 1, silver sits where it is today. But historically, that ratio compresses in bull markets: 40 to 1, 30 to 1, even lower. Hold gold steady, and silver moves. Raise gold, and silver accelerates. That alone gets you into the $150 to $300 range. Now layer in reality. Debt expansion. Currency debasement. The International Monetary Fund warning about U.S. debt sustainability. When confidence in currency erodes, hard assets don't rise, they reprice. That's how $300 to $500 becomes logical. And the final layer. A true systemic shift. Dollar confidence breaking. Physical shortages tightening, aggressive rate cuts, geopolitical stress feeding inflation. That's not a prediction. But if those conditions align, $500 to $700 stops sounding extreme, it becomes explainable. Let me be clear, every model we've walked through, ratio analysis, historical moves, currency debasement, they all point to the same zone: $500 to $700 silver. It sounds insane. I get it. But in 2020, at $12, if I told you $121 was coming, you would have laughed too. Math doesn't care what feels comfortable. It follows supply, demand, policy, and history. Now bring it back to today. The Strait of Hormuz is the short-term trigger. If conflict escalates, oil spikes, inflation rises, the Federal Reserve stays tight, silver pulls back. Maybe $72 to 74 cents. Painful, but temporary. Not guarantees. Not predictions. Just math, meeting reality. So I'll leave you with this. At $80, with everything building beneath the surface, are you early or already late? 6 straight years of supply deficits. Industrial demand from solar, EVs, AI accelerating. A macro system under pressure, debt, currency, policy constraints. The models point to $150, 300 seconds. Expansion takes it to 300 seconds, $500, extreme, but historically grounded conditions push $500, $700. So manage risk. Size positions correctly. Never bet what you can't afford to lose, because this isn't a trade, it's a position. Right now, silver sits near $80, still far below its highs, while underneath, the fundamentals haven't changed. Even in a true bull market, 30% drawdowns are normal. The path from $80 to $300 or $500 is not a straight line. It's chaos, doubt, false starts. Timing matters, and you can be right long-term, but wiped out short-term if you're not careful. Weak hands see volatility and freeze. Strong hands see something else entirely. A structurally scarce asset temporarily mispriced by financial mechanics, and they call it an opportunity. But let's be honest, credibility requires risk. Silver is violent. We just saw a 44% collapse this year, but by the time they feel safe, the move is already gone. Because while hesitation dominates the surface, smart money is already accumulating, quietly absorbing physical supply while paper markets stay distracted. That gap, that's where the opportunity lives. If tensions ease, oil drops, the dollar weakens, rate cuts come into view, and silver breaks higher. 95 now there's fast either way. The 12 to 18-month bias is the same, up. Here's the real psychology. Retail investors are still shaken from the $121 to $67 collapse. They're waiting $85 to feel safe, $90 to feel confident, $100 to believe again.